Wenner, I'll be your host here tonight. That's Larry's job. He's actually a vocalist. He's actually an opera singer. So we'll have him maybe perform towards the end here. So thank you everybody for coming. To put everybody at ease here a little bit tonight, I promise you we have no paperwork with us. We're not expecting anybody to sign anything here tonight. Or bring out any checkbooks. The goal tonight is just to give you some information about what we do. For a lot of you, it's a little bit unique. You probably haven't seen anything quite like we do. With the type of returns that we're able to generate, tends to be brought with a little bit of skepticism to how do we do this? How is this possible? And that's what we're here to explain to you tonight. Give you enough information that if it piques your interest after this, that we can sit down on a one-on-one basis and talk further. So with that said, I'm going to go ahead and get started. As I said, I'm your host. Sorry here. Okay, there we go. So I'm also the CEO of DLP and our family of companies. So as you can see, I know the screen there in the back's a little bit crooked, so I apologize. But as you can see, I'm joined in the pictures there by my wife, who's sitting in the back, and our two little boys, who are about to be 4 and 5 years old. We live in Palencia on the north end of St. Augustine, as well as Pennsylvania. So we go back and forth. You can probably see from the literature we're headquartered out of Pennsylvania and have offices here in St. Augustine and Jacksonville as well. So I've been in real estate for about 11 years. I've completed over 6,000 transactions, over $600 million worth of real estate deals. Currently own a portfolio of over 400 properties, including single-family homes, over 1,000 apartments, some commercial assets, and some subdivisions as well. We have a family of companies here. You can kind of see, it's a little hard based on where you're at, but that's our family of companies, which all of this information is in the brochures you have as well. And this is sort of how everything works. We have 5 core companies. DLP Capital Advisors, which is our investment company you're here to hear about tonight. Direct Lending Partner, which is our lending company. DLP Builders is our construction company. DLP Realty is our real estate brokerage, and DLP Property Management is, of course, our property management company. So to start us off, I'm going to start with a quote here from Warren Buffett, one of the smartest and wealthiest men in the world. He said, when asked by Tony Robbins how he became so wealthy, he said 3 things: living in America for the great opportunities, having good genes so I live a long time, and compounding interest. So a lot of what we do revolves around generating consistent compounding returns, including the first investment option we're going to talk about, which is just that, compounding interest. So this is often what the world of investing can seem like. Not quite sure which way to go. There's a lot of opportunities out there. In this market, everything seems either high risk or no return. Not usually, there's not many options that don't feel like they're one or the other. So what we're going to try to do today is give you a simple overview. It might still seem like a lot of information, but try to make it simple as to what we do and how we do it, most importantly. So what we do is 2 main things. We are vertically integrated operators. We buy multifamily real estate, apartments. So we buy apartment complexes, mainly 50 to 250 unit apartment complexes. That's the first thing we do. The second main thing we invest into is we make loans to real estate investors. So round of hands here, who has ever watched those HGTV shows about home flippers? All right, so most of us, right? So we make loans to the people who are buying houses, renovating them, and flipping them. So we lend money to professional real estate investors to flip houses. We have flipped over 800 houses ourselves over the last 8 or 9 years. So we know the business really, really well. So we are essentially the bank. You as an investor in the fund are essentially the bank. So I'm going to explain 3 different ways that you can participate in how we invest into those 2 strategies I just talked about: buying apartment complexes and making loans to real estate investors. Option 1 is you can lend money to DLP Capital Advisors, funds, and entities. So essentially, you're investing by lending capital to us. It's a little hard to read for some of you, but again, it's in the brochures. On the left, you'll see what the fixed returns that we pay are if you take the distributions each and every month. So you have the option of taking monthly distributions for a fixed return of 6.5% to 10% based on how much money you choose to invest and how long you choose to commit. You can commit for 1, 3, or 5 years. On the right side, the rates look a little bit higher, and that's because of the power of compounding interest. So those are what your returns would actually be on an annual basis if you choose to compound your interest. Not take distributions, but instead reinvest that interest each and every month. You have the option to take distributions monthly, have it compound. You can switch at any time. You can do a combination of both. So that's the first option. It's very simple. Fixed returns. We've been doing this for over 10 years. We've paid out an average of 9.3% fixed return to our investors and have done over 1,000 of these investments. And we'll talk a little bit more about that later. Option 2 is what we call the DLP Equity Fund 2. This is our newest investment fund. It will actually be open next week. It's a brand new fund. As you can tell, it's a follow-on. We're not all that creative, so it's a follow-on from our first fund called the DLP Equity Fund 1, which we opened about 5 years ago. So in this fund, what you're doing is you're becoming a limited passive partner, a passive owner in our multifamily, in our apartment complexes we own. So you're passive. This fund has the highest projected returns of anything that we do. It has tax shelters. So if you're looking to protect your money from Uncle Sam, this might be the best option for you. It has annual distributions. Actually, it's quarterly distributions, which is the rental income that we generate. And then the goal is to pay you out long-term capital gains at the end of this fund. So what we're doing is we're buying stabilized and value-add apartments. We're buying apartments that need renovation, which you'll see in a second. Mainly 50 to 300 unit apartment complexes. In addition, the fund will invest in some single-family homes and some other income-producing real estate. What we are able to do is leverage our in-house property management and construction company to maximize the value of these properties and generate consistent cash flow from our properties. We have a 10-year investment perspective in this fund, so it's an 8 to 10 year fund. So by going into this fund, you're committing for 8 to 10 years, but you do have an option to take your money out sooner. And the goal is to pay out a 17% plus annual return net to our investors. So our goal is to generate your long-term wealth through real estate. It's an 8 to 10 year fund. It has significant tax shelter benefits, mainly through depreciation. And you'll be a passive partner in our multifamily property with reduced risk, which we'll talk about a little bit further. So this is what you will not be doing. So for anybody here who's ever owned real estate themselves, you will not be dealing with a fund of tenants and dealing with real estate. You're a passive investor in what we do. What we're doing is purchasing underperforming and often neglected apartments. We're then coming in and maximizing those properties. So here's an example of the situations we like. Must sell, lost job, can't pay, mortgage, wife left, took dog, house is a gem except for the asbestos, best offer. Those are the type of situations we like, where there's a distress, property has been neglected, and we can come in there and add value. So you're able to relax in this fund. We're not here to sell you on becoming active real estate investors, to go out there and buy real estate. Instead, you're investing passively with us. We provide excellent property management, attention to the tenant's need, improved apartments, clean and safe environments, and a higher quality of living for the neighbors, etc. So we're coming in improving communities. In short, we provide everybody what they're looking for as far as our tenants, for their family, a safe and enjoyable place to live. And you'll see more about these types of properties here in a second. So we do all of our property management in-house. We have a senior vice president who's here in the middle of the room, Jason, who runs our property management division. We have regional property managers. Our Southeast regional manager is up here, Ken, who's our regional manager here in Florida and in the Southeast region. Asset managers, controllers, maintenance managers, turnover managers, and leasing expertise. So we do a lot of unique things. Example, we do 2-year leases for residential tenants, which is very unique. We want to keep our tenants in our properties for a long time. We have unique programs like our Renter Reward program, which incentivize tenants to stay in our properties. In addition, some of the other resources we deploy are our real estate brokerage. So DLP Realty has sold 1,126 homes in 2016. We're ranked the #1 real estate team in Pennsylvania and New Jersey by the Wall Street Journal, and the #8 real estate team in the U.S. by the Wall Street Journal. We're one of the 5,000 fastest growing companies in America for 5 straight years. And we've been the #1 workplace in our market of Lehigh Valley, Pennsylvania, which is where our company is headquartered. We also have one of the largest construction companies in the Northeast called DLP Builders, so we have construction expertise to maximize these properties as well. So we also have maintenance resource in-house, technology, and then we get a lot of benefits from size. So example, we're one of Home Depot's largest accounts in the country. So we get some additional buying powers and things like that due to our size. And we really focus on one of our core values of delivering wow to our tenants, our investors, and all of our clients, which helps our properties perform at a higher level. This is an example of some of our properties. So here you'll see all the way on the right-hand side, you'll see a community here called Villas at Woodland. This community here is in Jacksonville. But you'll notice these pictures don't look great on these screens, but you notice all these communities, and they're in your brochures as well, all look very similar. That's because all of these communities are what are called cardinal apartments. They're all single-story, one-story apartment complexes. So you have no neighbors above you. In most cases, you only have one neighbor. Individual private patios. So they feel more like homes than apartments. So you end up getting tenants who stay a lot longer and make it more like their home. We also attract an older crowd. In addition, they're smaller units, so usually older families in these properties. And they've been excellent for us. This is a builder who is called Cardinal Builders who built somewhere around 500,000 apartments. They're all almost identical throughout the Southeast. And that's one of our biggest focuses. This community here in Greensboro, North Carolina, we actually just bought yesterday. That's 128 units in North Carolina. That's our first property in North Carolina. This one here is in Jessup, Georgia, which is about an hour north. This one here is in Jacksonville. And then this one here is in Orlando. This is an example of what we do in apartments. So we come into a property that has dated kitchens, old flooring, and we come in and freshly paint, replace kitchens, improve lighting, update the bathrooms, etc. And we'll improve a community from rents of $500, increase the rents to $700, $750, attract a higher quality tenant, and increase the value of the property. These are some of the other properties we own. Actually, a couple of them are the same on here, but we have 139 brand new unit development in Pennsylvania. This one's in Daytona. Then we have a number of smaller communities in Pennsylvania. Another new community on the bottom right here. So let's give you some of the examples of the type of properties we own. Mainly 50 to 300 unit properties are what we're buying moving forward. So again, this is a little hard to read, but in page 4 or 5 of your brochures, you'll see where it says DLP Equity Fund 2. And this is an overview of the terms. So this is an 8 to 10 year fund. So we're going to own the real estate for the next 8 to 10 years. So the next couple years, we'll be going out there buying somewhere in the neighborhood of 2,000 to 4,000 apartments. So you'll be a partner in a portfolio of 2,000 to 4,000 apartments. Our goal is to distribute out quarterly returns to you of 1.75 to 2.25% return on your investment on a quarterly basis, which works out to be 7 to 9% distributions each year. Those returns are going to come from the rent we collect after paying our expenses. So that's this, and you receive a 7% preferred return, which means you earn 7% before we earn anything as DLP Capital, as the fund manager. The goal, though, is to distribute out a total return of 17% plus net to our investors. So each year you're earning 7, 8, 9% returns. The last couple years of the fund will sell the real estate off and will return back to you all your initial capital with the goal of distributing 2 to 2.5 times your return plus the 7 to 9% you earn each and every year. Great thing about this fund is every year when you're earning that 7 to 9%, most of those gains will be deferred from tax through depreciation. Then at the end of the fund, when we sell off the real estate, most of those gains will be long-term capital gains. So it's very tax advantageous. So this is a great fund for cash, for non-retirement or non-qualified money. And if the fund, as I said, is 8 to 10 years, but you can get out of the fund sooner. You do give up some of the back-end capital gains, but there is a way to get out of the fund sooner. But the goal of this fund is if you're looking for a longer-term investment. You only go into a fund like this if you're looking for an 8 to 10 year investment horizon. You're looking to earn the highest return on your money over the next 8 to 10 years. So that's the second investment option we have. So this is a good example of what we're not. So on the top it shows watching tennis, and the bottom it shows watching the stock market, up and down, up and down. Our goal of everything we do is distribute consistent returns, quarter in and quarter out, month in and month out. So, oops, whoa, all right. Not sure what just happened there. Hold on one second. All right, sorry about that. All right. So option 3 is investing in the bank. So we are not an actual bank, we're a private lender, but what you're doing is you're investing into an investment fund that makes loans to real estate investors. So we have 2 different funds that do this, the DLP Lending Fund and the DLP Income and Growth Fund, and they're both in your brochures right after the fund we just talked about. So in this fund, it's pretty unique. The goal is high yields, 100% passive, liquidity, so you can redeem your investment at any time with 90 days notice, consistent monthly distributions, and this is an excellent investment option for IRAs or for qualified money. So what we're doing is we're making loans to real estate investors to renovate homes. We're improving neighborhoods, we're driving local economies, we're providing jobs, and providing turnkey housing to families through the loans we make to these investors. So how this fund works, again, I know it's a little hard to read, but again, it's in your brochures on page 6 or 7, I believe. So this fund targets a 11% plus annual return net to investors. Historically, in the lending fund, we've averaged 15.2% net return to investors with quarterly liquidity and monthly distributions. It has a 10% preferred return. That means you earn a 10% return before we earn any profits, with a goal of generating 11% plus annual returns and an historical track record of over 15%. This is a month-by-month return of the fund. Our worst month was a little over 12%. Our best month was about 20%. Most months are 14, 15, 16% historical annualized returns net to investors. And that's an important comment to make, is that all of these returns we've been talking about are net. We don't charge financial management fees, any expenses that come out of your returns. Everything you see, all the returns we talk about, are the money net to you. I know what you're thinking. Wow. When you hear 11, 12, 15% returns, it sounds, really can often sound too good to be true. And we're going to kind of show you now how we're able to do this and give you the confidence that we're doing this right here in this market. So these are examples of some of the loans that we make. Typically, we're making first position loans. All of our loans are first position loans to real estate investors. On an average, we're 58% loan to value. On average, the investor's putting in 25% of their own money into the deal. And on average, we're just under a 14% interest rate that we charge to the borrower. So high yield, but we believe low risk loans. There's a bunch of different examples. We're lending on average single family homes, $200,000, $250,000 homes on average. Here's a breakdown of where our loans are. I'm going to show you where all of our assets are. So we're headquartered out of a place called Lehigh Valley, Pennsylvania, Bethlehem, Pennsylvania. Anybody here ever been to Bethlehem other than DLP employees? Okay, a few. So we're about an hour north of Philadelphia in Lehigh Valley, Pennsylvania. That's where our company's headquartered. So about 17% of our loans are there. About 21% of our loans are in the Philadelphia and Delaware Valley. About 24% currently are in New Jersey, 34%, sorry. A little bit out in Harrisburg, the state capital, and 29% here in Florida. So currently all of our loans are in Pennsylvania, New Jersey, and New York. As you see on the right in this pie chart, 86%, I believe is the number there, are on single family homes. A small percentage are on multifamily, and we have one commercial loan. Most of those multifamily loans are on 2 or 3 unit properties. So it's mainly single family, small asset loans. This is a breakdown of all the assets that we own, where they're located. So I'm coming a little closer so I can read this. 37% are in that Lehigh quarter. 29% are, or 28% are here in Florida. 2% 21% in the Poconos. Have you ever been? Okay, a couple. And 9%. And now officially after yesterday, we do property in North Carolina as well that didn't make it own. 50% of all of our money is invested in single-family homes. We still own over 400 single-family homes. 32% is in multifamily, and 19% is in commercial. So again, the question you're asking yourself at this point, is this a great deal or is this too good to be true? And we'll show you how we believe we can back up what we just showed you and validate how this is a great deal. So one big part of that is we've gone through a lot of due diligence here over the last few years to become what some would call institutional quality investments. One of those big steps that we went through is a process to get approval through all of these big companies that you probably all have heard of before, that you can actually make your investment with us through all of these institutions. So we are approved on all of their platforms and about another 100 different platforms, but these are 6 of the big ones. So 94% of the major brokerage custodians now support us, and we've been approved through a detailed due diligence process. In addition, we have audited financials on our funds as well by third-party CPAs. So one of the great ways to invest with us is through your IRA. So there's a little quote here that says, have you thought about aging slower? Your 401k is in terrible shape. For a lot of our investors invest IRA money, qualified money with us. It's a great vehicle for that. You can do that through all those major brokerage custodians I just talked about, as well as through self-directed IRAs. So let me tell you a little bit about our history. We have 175 investors with us right now. We actually have a pair of our investors who came all the way in from Pennsylvania, who've been with us for a few years. They can tell you about their experience here tonight. We have 0 principal losses to any of our investors. 100% of every month that we've been in operation, we've hit our monthly fixed and preferred return targets every single month. So not only has nobody ever lost any money, nobody has ever missed their return target for a single month. We have 144 employees who work for the DLP companies across now 5 states, including now North Carolina. We do over $50 million in annual revenue across our DLP companies. We have a 9.3% average fixed return to all of our fixed return investors over the past decade. In each of our individual funds we manage, and I talked about a few of them, we have a few others that aren't open to new investors. The lending fund is averaged over a 15% historical return net to investors. The income and growth fund is averaged over a 13% annualized return net to investors. The DLP fixed fund over 14% net to investors. And our first equity fund, which is still in operation, has distributed out over 9% net to investors through rental revenue, with a goal of generating over 25% net to investors, and it's on track and actually is going to start winding down and start selling off assets here in the next couple years, as the equity fund 2 will do in about 8 to 10 years from now. And then we as DLP Capital, which I'm the main owner of, and also my CFO and General Counsel, Bob and Barry, who you'll see in the brochures, are also partners in DLP Capital. We have over $3 million of our own money invested directly into these funds, including a lot of money co-invested into the assets that we own. We own over $165 million worth of real estate, over 400 properties, and over 100 private loans, over 400 single-family homes in that portfolio, in addition to about 50 different multifamily properties, about 20 different commercial properties. We've completed over 800 single-family flips since 2007, and we manage 5 private funds that we just talked about. So where are we going? So some of you might say, all right, you're doing all this stuff already. You have all 175 investors. You have $100 million worth of capital invested with you. Why are we here tonight? Why are you having us out here for a free dinner, other than because you like us so much? Why are you doing this tonight? Well, even though we've accomplished a lot here over the last 10 years, we have some pretty big goals over the next 8 years, which is by 2025, this is a target we set 2 years ago. We set our 10-year targets, is to have $1 billion in real estate, and $1 billion in loans. So $2 billion in assets. Right now we have $165 million. So we have just a little bit of work to do. So this is why you're here. We're still growing. We're still very optimistic and on our strategy, both in terms of our lending business and our multifamily, even when the real estate market goes into recession again, which it will. We're endorsed by some really big personalities. Locally here, Rich Jones, Sean Hannity. So our investing activities we talked about are concentrated in Lehigh Valley, Pennsylvania, Poconos, St. Augustine, Jacksonville, Daytona Beach, Orlando, Delaware Valley, which is the suburbs of Philly, and North and Central New Jersey. As we move forward, we'll continue to invest into those states heavily, as well as into other states in the East Coast, such as Georgia and North Carolina, that we've moved into in the past year. Here's a little bit of information about Lehigh Valley. It's the third largest Holly Hills, where our Florida headquarters actually soon in Orlando. We lend and invest in up and down this northeast coast is predominantly where we are, as well as central Florida. So, show me the money. So, recap everything I just showed you. I know is a lot of information. Another quick little quote I like. For your next vacation, I'm going to take you, taking the family to the Wall Street. They've got the most terrifying roller coaster I've ever seen. So again, we're not at all related to the stock market. Obviously, the stock market is at all-time highs right now. When you're at all-time highs, in my opinion, there's only one way you can go. So we are very much uncorrelated to the stock market. I know it seems like a lot of information. Might feel like you got sprayed in the face there. But I'm gonna pull back up here. Actually, I thought I had them here. I guess not. So I'll just recap them here in the verbally, just quickly, and then I'm going to open it up to questions as you eat dinner. So again, we have 3 investment options. They're all in the brochure. They're in this order. The DLP fixed notes, which are fixed notes from 6.5% to 10%. Those are fixed returns that you lock in with us, and you're guaranteed those returns from us. They are not guaranteed by the FDIC, but they are guaranteed from us. We sign a contract with you guaranteeing those returns. Then you have the DLP Equity Fund 2, where you're a partner in our apartment complexes, goal of 17% annual returns, tax shelters. And then lastly are the Income and Growth Fund and the Lending Fund, which our goal is to distribute 11% plus returns on your investment with only a 90-day commitment period. You invest for 1 year, but you can redeem at any time with 90 days notice. So with all that said, I'm open up. I know you're just getting your dinners now, so some of you will have your mouths full here a little bit, but I'll walk around here, answer questions. Please feel free to ask questions. I've already heard a lot of the same questions as I walked around before this, so any question you have, I promise there's other people with the same question. So please feel free and ask, and I'll walk around to you when you put your hand up. So first question here.
I'm just curious how you got started.
Great. So our question was, how did we get started, or how did I get started in real estate? So I got started in real estate sort of by mistake, like a lot of people. So I went to Drexel University in Philadelphia. I was studying finance. I actually thought I was going to be sort of what we are now, which was a wealth manager. So I was getting all my licenses to become a wealth manager. I worked at Merrill Lynch, BlackRock, a big tax firm. And while I was doing that, I got convinced into taking a job in a business of security, ADT security. And I started selling security systems door to door. Yes, I was one of those guys who knocked on your door and sold you an alarm system. I did really well doing that, and the owner of that company happened to also be in real estate, like everybody was in 2005. You might remember back in those days, when you would get pulled over here in Florida, the cops didn't ask you for your driver's license, they asked for your real estate license, right? Because more people had their real estate license than a driver's license, but everybody was in real estate at that time. But he convinced me if I could sell alarm systems door to door, I could sell real estate. So I got my real estate license and had a lot of success right out of the gates, but always had a passion for wanting to be in finance and managing capital. And then one day in 2007, when the market started turning, an investor I was representing couldn't show up to a closing table to buy the house. And I had a little old lady crying across the table from me that she needed this money, she needed to close. So I went to the bank and got the money and bought her house, renovated it, sold it, and flipped it in a few months. Made a $20-some thousand profit. Did about 5 of them that year, about 20, 30 the next year, and it continued to grow from there. Sort of happened by mistake, but it's been a great 10 years since. Great question. Right back to you.
Why do people come to you for loans?
Why do people come to us for loans? Great question. So one of the big political topics has been deregulation, right? We've all been hearing about that. It's very hard to get loans. There's all this regulations. So that's a big part of it is banks are very limited to being able to lend on these types of loans. They're very limited in lending on real estate in general. So that's the first part is banks really can't lend on this type of real estate, which is speculative, meaning there's not rental income coming in on it. The other big thing, the biggest thing that a lot of this regulation has caused is slowdowns. So if you go to a bank right now for a loan, so Sandy here, who's in real estate as well, she could go to the bank right now and she could buy a property and say, I'm buying this property for $1 million. And it could be the bank she does a lot of business with. She could have $1 million in the bank with that bank. She could be buying a property for $1 million and be putting down $900,000 cash, right? So if you went to a bank and said, I need a $100,000 loan on a property for $1 million and I have $1 million in the bank. Sounds like it'd be pretty easy to get that loan, right? It would still take you, if you push them hard, 8 weeks to get that loan done. That's how slow commercial banking is now. So these buyers, to get these great deals, to buy these distressed homes, they have to be able to come in there and buy these homes cash, close quick, no contingencies. So our ability of speed. And then the other big thing is we bring these borrowers a lot of value. So we help teach them. We help guide them through the renovation. We help them with construction resources. We really help become their partner and their backstop in their investing activities that keep them coming back to us again and again.
Okay, thank you.
Great question.
Appreciate it.
Somebody had a question?
You mentioned that you were charging 14% interest for these loans. Are these, you're able to charge 14% because these people have bad credit or there's very risky sort of a situation?
Great question. So he said, so we're charging 14%. Does that mean because these people are so risky? They can't have bad credit, they can't get a loan. First of all, the big thing to understand in how we lend is our loans are typically 6 months in duration. So 14%, if you were taking out a 30-year mortgage, sounds really expensive. But if you're only taking out a 6-month loan, that means you're going to pay 7% for that money in 6 months. So they look at it as a cost of the deal and analyzing if they're going to be able to make a profit, not so much as looking at it as a long-term interest rate. So they're not going to keep this loan long-term. It's a short-term loan. With that said, we underwrite harder and, in my opinion, better than most banks. So we do full appraisals. We go out and actually inspect every single property we make a loan on. We fully underwrite the borrowers, 2 years tax returns, pull their credit, we pull a background check. We go in and analyze their cash. We require bank statements. We run full cash flow analysis on these borrowers. We underwrite them as detailed as a bank is, except we're not stuck by silly regulations. We can use common sense. So we go through and we're very, very thorough. So most of our borrowers, our average borrower has a net worth of over $1 million. Our average borrower has over $100,000 in the bank. Our average borrower has about a 680 credit score. Our average borrower has over $100,000 adjusted gross income. So most of these borrowers are bankable. The properties they're buying and the speed they need is not possible for a bank. So not every one of our borrowers is bankable, but the vast majority is. And we require these borrowers to put, on average, 25% of their own money in the deal as well. So a quick point I want to make about lending, because always a question of, well, 2008 happened, right? And there were all these foreclosures. So in 2008, through the downturn, there were over 10 million homes that foreclosed. 10 million. Who wants to take a guess at how many of those homes, how many of those mortgages, the borrower, the homeowner, put 20% down on that purchase? Very little, none. Any other guesses? 10%? Half? So well under 1%. So it was less than 10,000 of the 10 million homes that foreclosed put 20% down. So lending is not that complicated. When a borrower puts 20% down, they pay their bills. And even if they don't, they can sell the property in most cases. But typically they pay their bills and they don't walk away. Every bit they get closer to 0% down, the more likely they are to walk away. So we believe that's one of the basics to lending, is that we're lending to people who are putting their own money in it. In addition, we're not lending to a homeowner who, if he loses his job, he can't afford to pay his mortgage. We're lending to active investors who own other real estate, have other income sources, etc. So that's a really big detail, is that we're focusing on cash invested, which it puts us in a great position. So right now we have one loan that's more than, what's today, the 16th, 17th? More than 17 days late. One loan in our whole portfolio. We've had no foreclosures. We've had no losses on any loans we've done because of the type of underwriting we do.
Do you get your properties by sending out those postcards, we buy ugly houses, or we buy distressed properties, or we saw you, have renters or whatever? Are you one of those companies?
So she asked if we get our houses we buy through sending out those we buy houses type marketing. So keep in mind, in our lending business, we're not the buyer. We're the lender. So do a lot of our borrowers do those type of marketing? Absolutely. Our borrowers are the guys out there saying, we'll buy your home for cash. Now for us, out of the 800-900 homes we've bought, a lot of our deals have come that way, in that in Pennsylvania on talk radio, where a lot of you found us, we market your home sold in 68 days guaranteed, or we'll buy it. And we market, we'll buy your home cash as is, no contingencies, no commissions, etc. So a lot of people come to us, and we buy a lot of estate sales or aging situations, is what we end up buying. The homes with the yellow carpet, shag carpets, and the yellow walls, and the pink kitchens, and wallpaper on the ceilings. A lot of those homes in the Northeast that were built in the 40s and 50s and haven't been touched in 40, 50 years. The hardwood under the carpets, and they never took the carpets up type of homes. If anybody's been in the Northeast at all, you'll know what I mean. So that's a lot of what we've bought, not the traditional foreclosures that came through the downturn.
Yeah, I just wanted to say, just as a recommendation for this group here, we are a mortgage company, Crossview Mortgage here in Jacksonville. We are Jacksonville's #1 mortgage company in the state of Florida's #1 ranked company for trustworthiness and integrity. And as the founder of Crossview Mortgage, I want to say this: we do business with these people. They're sharp, they're integrity-minded. They have done properties that we can't do. We can't find lenders, and we built a relationship with them. They are trustworthy, thoroughness, their integrity. Larry and Dawn, thorough in getting the loan done. At 720 credit scores we sent you guys, distressed properties, able to do it, no problems at all. So y'all will be very pleased with DLP
Awesome.
Capital.
Thank you, Tim. Appreciate it. Thank you very much. Yes, sir.
Don, I have a question. I'm a real estate broker, have been a native of Jacksonville for 64 years. When you lend money, I'm still confused about how and where and the criteria for you lending money.
So,
and are you borrowing the money to lend, or is it already your money?
great question. So his question was, he said he's a real estate broker here in Jacksonville, a native of Jacksonville, and he's still not clear on who we lend to, how we lend, what money we're lending. So the money we're lending are our money, individuals' capital. So it's the money we manage in these funds, which was one of the questions somebody had asked for. Well, why does somebody pay these 14% interest rates? One of our big value pitches is it's our capital in our funds that we manage. We don't have some underwriter in Chicago who has to approve our loan that we're at their mercy. We control the money. If the loan makes sense, we fund it. So we're able to use common sense and understand guidelines that work. In addition, we go out there, our own in-house employees go out there and inspect every single one of these properties and evaluate the actual asset. In many cases, we've actually met and know the borrower face to face as well. So that's why right now all of our loans are in Pennsylvania, New Jersey, and Florida, in markets we know, understand, and where we're actually a real estate broker in all the markets we lend in. Great question.
You described the investments as passive investments. What's the average tax ramification of those if they're not in an IRA?
Great question. So her question was tax ramifications of these funds. So the first option and the last option, so the fixed returns, the 6.5% to 10% fixed returns, and the lending fund and income and growth fund, 11% targeted returns, both of those investment options are taxed as ordinary income if you do not invest through qualified accounts, if you're not using your retirement money. So whatever your marginal tax bracket is what you'll be taxed at. So with that said, of course, the way I always look at it and say, if I give you a 13% return and you got to give Uncle Sam 3 or 4, you still got 9 or 10. It's not the worst thing in the world, but that's why investing qualified money in those funds is so attractive. The equity fund too, the fund that owns the real estate, has some great tax shelters, some great tax deferral. So each year, so let's say you invested $250,000 in that fund, and we distribute to you 8% this year, $20,000. Most of that $20,000 will be sheltered from tax. We estimate you'll end up owing tax on, at most, $2,000 to $4,000 out of that $20,000, because depreciation is going to defer a lot of that tax, because depreciation is a non-cash tax deduction that'll defer off a lot of those gains of money you actually received right now. That's the first benefit. The second benefit is at the end of the fund, when we sell off all the properties, most of those gains that if you recognize them then, you're going to be taxed at long-term capital gains, which currently is roughly half of what a lot of our marginal tax brackets are. And moving forward with the proposed tax plans might be even lower. It's very much tax advantageous, which is why for cash, the equity fund too is a highly attractive investment option. But at the end of the day, the other options, if it's cash that you have to invest, you just look at it. If I earn 10%, I give Uncle Sam 2 or 3. It's better than having earned 2 and have it all sheltered, of course. Great question. Anybody else back here? I think somebody here had a question before. You, sir?
Well, I think you answered it already, but what percentage of your, what percentage you have to write off as bad income? In other words, non-payment of rentals?
Of rentals?
Well, yes, or anything. What do you have?
Sure. So with our loans, first let's talk on the loan side first. We have 0 write-offs. We've never written off $1 of principal. We've never written off $1 of interest. So we've never lost a nickel on a single loan we've done as far as principal or as far as the returns owed. Not $1. So it's gone very, very well. In our rentals, in our rental portfolio, certainly we have situations where we have non-paying tenants. So we focus really hard through a really tight screening process to minimize that. But certainly we end up with some uncollected debt through money owed to us from our tenants. So the target there is to end up with under 2% of uncollected rent. Which is pretty strong in the apartment space.
Don, I hate to ask you this one question, but I think it's important for everybody. Are there any pending lawsuits against your company?
No. so no, that's not a hard question for us. So no. So no, we don't have any lawsuits. The only, if you want to get truly technical, the only litigation we're dealing with is sometimes on evictions. So we do have a few outstanding evictions going on, which we're not being sued. We're doing the technical suing, but that's all we have. Great question. Anybody else?
I don't want to put you on the spot, but I'm trying to understand about the depreciation. If I sell the house that I've rented to tenants for 10 years, and I've been taking depreciation, I have to, they recapture all that depreciation essentially when I sell the house. How do you avoid, or how do we avoid, if we invest in your fund, not having that depreciation recaptured?
So our question was about depreciation recapture. So as I said earlier, each year when we're using depreciation, you're not avoiding the tax, you're deferring the tax. Okay, so if right now you earn $10,000 this year and depreciation writes off $8,000 of that you don't owe any tax on this year, when you sell that property, you have to recapture that depreciation. So unless you do a strategy like a 1031 exchange or some different things that we can certainly talk about at that point, when it would come due time to pay the tax, when we'd sell off the properties in 8 to 10 years, you get all your money back, you will owe tax then. But the benefit is you're going to be taxed at long-term capital gains versus being taxed at an ordinary tax bracket, which for many of us, that's a 50% or lower tax bracket at long-term capital gains than being taxed at our ordinary tax bracket. Plus, you were earning returns on that money that you would have given to Uncle Sam this year each year. So that's another big benefit. If you can give Uncle Sam that money in 10 years from now and have earned money on it every year for the next 10 years, that's a very significant difference in what your overall return would end up being versus paying that tax this year. Great question. Any other questions? Oh,
The choices you made up there on the monitor screen, the screen, is there a variable amount, minimum investment per fund, and what is the minimum investment?
great. Great. So his question was, what is the minimum investment of the different options we talked about? So each of the investment minimums are under each of the funds in the brochures. So the minimum investment for the private notes or the fixed notes is $100,000. That investment, and this goes for all of our investments, a couple of key points. That $100,000 can be across any multiple number of accounts, meaning you could say, all right, I have $50,000 in my wife's IRA, and I have $50,000 of cash. Okay, those are two separate accounts technically, but we look at that as $100,000 total. So it could be broken up into 2, 3, 4, 5 accounts, cash, non-cash. It doesn't make a difference. In the equity options, the equity fund, the lending fund, the income and growth fund, they have a $250,000 minimum investment. But we look at all of our accounts as one. So what I mean by that is, let's say you had $250,000 and you said, but I want to invest some money into the fixed notes, and I want some money in the equity fund, I want some money into the lending fund as an example. You could break that $250,000 up. So you could invest $100,000 into a note, $100,000 in the lending fund, and $50,000 into the equity fund. And again, that could be broken up over multiple different types of qualified and unqualified accounts. That it can work anyway. So we just look at everything as a couple, as a family, as one account, and we look at the minimum account balance as your overall balance of everything you have with us. So, great question. And the other thing I should mention, and it's in the brochures as well, is if you're not an accredited investor, the only option available is our private notes. So the definition of an accredited investor is a Securities and Exchange Commission term that means you have $1 million in total net worth, not including your personal home, or a $200,000 adjusted gross income. One or the other requirement. How you verify that you're an accredited investor is A, you have your lawyer or your accountant give you a 1-paragraph letter, which we would give you a sample of saying you're accredited. Number 2 would be you show a copy of your tax return showing, or first page of a tax return showing your income. 3 would be showing brokerage accounts or retirement accounts that show $1 million balance. Or 4 is to fill out a personal financial statement showing your equity and your liabilities. So any of those 4 options you can do to pass that accredited standard. So again, if you're not accredited, so if you say, look, I have money in retirement accounts, I have $500,000 in all my accounts, or whatever the case is, but I don't meet that standard, you can still do our private notes, which is the 6.5% to 10% returns. Any other questions? All right. Well, then I'll let everybody enjoy. I think we have desserts coming out shortly, so everybody enjoy desserts and coffee, and I'll walk around and answer any questions you didn't want to be brave and ask in front of everybody else. And Larry will be around here as well. In addition, can all the DLP employees stand up quickly? So we have a few employees here. Actually, mostly all in property management. So Jason, who's our senior vice president, Ken, who's our regional manager, and Ken's son, Kenny, who's our manager of our Jacksonville properties here. So you have some great people in addition to myself and Larry, who's our investor success manager, and Mandy, who can answer questions and give you some different perspectives on what we do and how it works. So I look forward to hopefully chatting with a lot of you yet tonight, and thank you all for your time.